whereas Adidas, on the other hand, had a relatively high debt. As you can see here, it sort of breaks down into the percentages. Nike's only 2% of their company had been in debt, whereas Adidas is at 32, which is quite troubling for a sportswear company that's that large. With that being said, I was able to calculate the debt to equity ratios, get a median for that by sort of multiplying them with the rest of these companies. And then I was able to find the levered betas due to research on various financial websites. And the beta is usually the riskiness, the volatility of one stock. So the higher it is, the average would be considered 1. Anything higher would be very risky. Anything lower would be a safe bet. So Nike was sort of a safe bet, and then at least the most volatile one was Adidas, with its company stock like fluctuating 10% on a daily basis. With that being said, I went on. So I was able to calculate all the median values and use that to find my WACC later on. The risk-free rate is the treasury yield, which is on the bonds that the U.S. government provides. The current yield on that is at 2.42%, and then the market risk premium is sort of a standard constant that investment bankers use, and for the current year it's 6.96%. The comparable company median risk factor was calculated through all of these numbers, and it came out to be 0.91. That's sort of the risk out of the scale of 1, so it's a slight. Nike would be considered a safe bet as it's under the average of 1. And then the industry-specific cost of equity. This reveals sort of the median of what the cost of equity is across the sportswear industry. And with Nike being a relatively large company, the small size company premium, which is another discount used when valuing companies, is relatively low, whereas if it were a smaller company, it would be higher, as the risk is greater with smaller companies when investing. Ultimately, with the cost of equity, it came out to be 8.93%, and then subtracting the cost of debt, my weighted average cost of capital or discount rate that I was going to use to go on and value the company in my DCF came out to be around 8.8%. Now onto my DCF. This is the discounted cash flow. This is a valuation model that investment banking analysts use on a daily basis to value companies. It's usually, it takes into account the cash flows that the company has on a yearly basis, and then using the discount rate, it calculates through the WACC or whatever other method the analyst chooses to. They're able to come out with the valuation. So for the net revenues, Nike currently is growing around 15%. So I would expect it to continue growing around that rate, around 14%. As the years go on, I would expect it sort of to drop down to 10%, because 14% is a relatively high growth rate for a company, and eventually I would expect the growth rate to sort of normalize around 4 or 3%. So my valuations, or my projections for my net revenues grew around like 3,000 each year, and ultimately the terminal value came out to be 48,566.6 and a terminal growth rate of 2%. To explain the terminal value is the value or the growth rate of the company in perpetuity, which is till forever. Investment bankers, when they think of valuing a company, when they're interested in either buying or helping to sell it, they think of the value of the company as the company would never end. So with that being said, the growth rate at 2% is very reasonable given the fact that the U.S. economy currently is growing around 3%. So with a company with the growth rate being any higher than 3%, that'd be a very inaccurate projection, just to the fact that a company can't grow faster and produce more revenue than the entire United States as a whole. So I was able to use that as common sense to gain my terminal value. The EBITDA, which is the earnings before taxes and deductions, also continued to grow around 14%. This was a normal rate within the sportswear brand, around 14.5 to 14.8%. So the terminal value for that came out to be 14.8%. And then the EBIT, which is the earning before just plain taxes without the depreciation and amortization, came out to be $8,000 for the year, an increase around $1,000 a year. And with the EBIT, it takes into account the taxes plus the depreciation and the amortization, the capital expenditures, which are the capital, the cash that the company spends. And ultimately, with all this being plugged into the model, I was able to come out with these are the free cash flows that one would expect for these years. And ultimately, for the terminal value to be around $6,800 for the free cash flows that the Nike would expect to have on a yearly basis. And with that, I was able to calculate the cash flows over the discount rate at 8.8%. So I was able to get that sort of valuation per year if you were to value Nike on a yearly basis. Those were my calculations, and ultimately the terminal value, or the current present day value of Nike, is estimated to be around $68.9 billion. And as you can see through the calculations, this is the present value of future cash flows, present value of terminal value, the standalone enterprise value. So currently the enterprise value, which is different from the present day value, is 71. So usually when investment bankers come to valuing companies, they usually go right between the present day value and the enterprise value and usually get a number in there. And with that, with investment banking, due to the fact that a lot of these companies are in the billions and millions, the margin of error is slightly increased. So ultimately my valuation came out to be, the implied equity value came out to be $69,957.2 billion, which is, like I said, right in between those two figures. And then I was able to calculate the implied earnings value, which is sort of tells at what rate the stock is being traded at. So this revealed to me that Nike's present day stock is being traded at 16.5 times its actual value. So I found that to be very interesting, because I was at the time when I started studying investment banking, stocks, and finance in general, I wasn't aware that stocks would be trading that over by that much, maybe like by 4 or 5 times, but I didn't expect it to be like 16.5, which I found to be truly astonishing. With that being said, that was my final product, and I was able to sort of get the gist of what an investment banking analyst does and sort of mimic what they would do on a day-to-day basis, and it's truly helped me build some key skills I will use later on, hopefully once I enter the investment banking field. Following my final product, here are some future plans I have once I finish off high school and finish off in ISM this year. I intend to attend the University of Texas at Austin and study finance. UT Austin is one of the best has one of the best business programs in the entire nation, and with the connections that the Longhorn alumni have, I feel like I'd have the opportunities to intern at an investment bank and also be able to network, like I said, which is key to finance. And eventually I'd love to land a job at an investment bank and maybe one day work alongside you, Mr. Goodwin. So we'll see how that goes on. But overall, I'd like to end this presentation by thanking everyone here. I truly appreciate you guys being here. None of this would have been able to happen without you, my parents. Thank you for being there, for supporting me, providing me with transportation and everything I needed to complete this entire journey. Thank you, Mr. Goodwin, for always being there, meeting with me on a weekly basis. This is truly a mentorship I wish I would have more of. And thank you for all my friends for being here. You guys are my support system, and you guys have provided me all I've wanted through my 4 years of high school, and hopefully I will continue to maintain these friendships, these mentorships, these ties with all of you guys here today, and hopefully you guys will be able to see me flourish later on in my career. So once again, thank you to everyone today, and with that being said, I'd love to open up to questions. No questions? Okay.